Question 1. The efficiency study reveals that a key third-party provider responsible for processing customer claims is consistently exceeding agreed-upon service-level agreements, leading to increased operational costs and a decline in customer satisfaction scores. Which of the following represents the most effective and compliant approach to address this situation? Option A. Impose financial penalties on the third-party provider based on the observed cost overrun, without a formal review of the root causes of the inefficiencies. Option B. Immediately initiate contract termination proceedings with the third-party provider due to their failure to meet performance expectations. Option C. Conduct a thorough review of the third-party provider's performance against contractual obligations and regulatory requirements, and then collaboratively develop a detailed remediation plan with the provider to address the identified inefficiencies. Option D. Implement significant internal process changes within the financial institution to compensate for the third-party provider's underperformance, without directly engaging the provider on the issues. Correct answer is B. Immediately initiate contract termination proceedings with the third-party provider due to their failure to meet performance expectations. Explanation. This scenario presents a common challenge in financial services, balancing the pursuit of operational efficiency with robust risk management, particularly when outsourcing critical functions to third-party providers. The professional challenge lies in identifying the most effective and compliant method to address identified inefficiencies without compromising service quality, regulatory adherence, or client data security. Careful judgment is required to select an approach that not only rectifies the immediate issues, but also establishes sustainable operational excellence. The correct approach involves a comprehensive review of the third-party provider's performance against contractual obligations and regulatory requirements, followed by collaborative development of a remediation plan. This is the best professional practice because it directly addresses the root cause of the inefficiency by engaging the responsible party. Regulatory frameworks, such as those governing operational resilience and outsourcing in financial services, mandate that firms maintain oversight of their third-party relationships and ensure that outsourced activities do not degrade the firm's ability to meet its obligations. This approach aligns with the principle of accountability, where the firm remains ultimately responsible for the actions of its service providers. It also fosters a proactive and partnership-based relationship, which is more conducive to long-term operational excellence than a purely punitive or disengagement strategy. An incorrect approach would be to immediately terminate the contract without a thorough investigation. This fails to acknowledge the firm's responsibility in selecting and managing the vendor, and it could lead to significant disruption in service delivery, potentially impacting clients and violating regulatory requirements related to business continuity and operational resilience. Another incorrect approach is to solely focus on internal process improvements without addressing the third party's role. While internal improvements are valuable, they do not resolve inefficiencies stemming from the provider's performance, leading to a superficial fix that doesn't address the core problem and may still leave the firm exposed to regulatory scrutiny regarding vendor management. Finally, an approach that involves imposing penalties without a clear contractual basis or a structured remediation process is also flawed. This can damage the vendor relationship, potentially leading to decreased service quality or even contract disputes, and may not effectively drive the necessary improvements. Professionals should approach such situations by first understanding the scope and impact of the identified inefficiencies. This involves data gathering, root cause analysis, and a review of existing service-level agreements, SLAs, and contractual terms. The next step is to engage the third-party provider in a constructive dialogue, presenting the findings and collaboratively developing a plan to address the issues. This plan should include specific, measurable, achievable, relevant, and time-bound, SMART objectives, with clear responsibilities assigned to both parties. Regular monitoring and performance reviews are crucial to ensure the plan's effectiveness and to maintain ongoing compliance with regulatory expectations for third-party risk management. Question 2. Regulatory review indicates that a financial services firm is undertaking a DMAIC project to streamline its customer onboarding process. The project team has identified potential efficiency gains through reduced data entry steps. Which of the following approaches best ensures that the operational improvements align with regulatory requirements and maintain a high standard of operational excellence as expected in the financial services industry? Option A. The project team conducts a thorough regulatory impact assessment of the proposed changes, involving compliance and legal departments, to ensure no new compliance risks are introduced and that existing regulatory obligations are met throughout the DMAIC cycle, particularly during the improve and control phases. Option B. Project team proceeds with implementing the efficiency gains, assuming that streamlining processes will inherently lead to better regulatory compliance, and plans to address any compliance issues that arise after the improvements are in place. Option C. The project team focuses solely on achieving the defined efficiency targets, deferring any discussions or assessments related to regulatory compliance until the project is completed and operational. Option D. The project team implements the changes based on efficiency metrics and relies on the firm's existing general compliance training to ensure that the new process remains compliant with all applicable regulations. The correct answer is A. The project team conducts a thorough regulatory impact assessment of the proposed changes, involving compliance and legal departments, to ensure no new compliance risks are introduced and that existing regulatory obligations are met throughout the DMAIC cycle, particularly during the improve and control phases. Explanation. This scenario is professionally challenging because it requires a financial services firm to balance the imperative of operational efficiency, as driven by a DMAIC project, with its stringent regulatory obligations. The firm must ensure that any process improvement initiative, even one aimed at enhancing service delivery, does not inadvertently lead to non-compliance with established financial services regulations. The core challenge lies in integrating the structured, data-driven DMAIC methodology with the proactive and reactive compliance requirements mandated by regulatory bodies. Careful judgment is required to ensure that the improve and control phases of DMAIC are implemented in a manner that upholds, rather than undermines, regulatory adherence. The correct approach involves a systematic integration of regulatory oversight into the DMAIC framework. This means that during the defined phase, the project scope must explicitly consider regulatory requirements. In the measure phase, data collection should include metrics relevant to compliance. The analyze phase must identify root causes of inefficiencies that may also be linked to compliance gaps. Crucially, the improve phase should not introduce new regulatory risks, and any proposed solutions must be vetted for compliance. The control phase must establish ongoing monitoring mechanisms that include regulatory compliance checks. This integrated approach ensures that operational excellence is pursued within a robust compliance framework, aligning with the LOMA 335 exam's focus on operational excellence within the financial services context, which inherently includes regulatory adherence. An incorrect approach would be to proceed with the DMAIC project without explicit consideration of regulatory implications. For instance, implementing process changes solely based on efficiency gains without a prior regulatory impact assessment could lead to violations. This failure to integrate compliance into the improve phase is a significant regulatory and ethical lapse. Another incorrect approach is to treat regulatory compliance as a separate, post-project activity. If the control phase focuses only on operational metrics and neglects to build in continuous regulatory monitoring, the firm risks falling out of compliance once the project team disbands or the initial intense focus wanes. This demonstrates a misunderstanding of the ongoing nature of regulatory responsibility. Professionals should employ a decision-making framework that prioritizes a risk-based approach to DMAIC projects. This involves 1. Scoping the project to include regulatory considerations from the outset. 2. Engaging compliance and legal teams early and often throughout the DMAIC cycle. 3. Conducting thorough regulatory impact assessments for any proposed improvements. 4. Establishing clear control mechanisms that incorporate regulatory compliance monitoring. 5. Fostering a culture where operational efficiency and regulatory compliance are viewed as mutually reinforcing objectives. Question 3. Cost-benefit analysis shows that implementing natural language processing, NLP, for customer interaction analysis could significantly reduce operational costs by automating the identification of key themes and customer sentiment. However, the firm must decide on the most appropriate implementation strategy to ensure both efficiency and regulatory compliance. Which of the following approaches best balances these objectives? Option A. Employ NLP to analyze customer feedback for marketing campaign optimization, assuming anonymization is sufficient. Option B. Implement NLP for sentiment analysis and topic extraction, with a protocol for human review of flagged interactions to validate insights and inform process improvements. Option C. Deploy NLP for automated customer service responses based solely on sentiment analysis to provide immediate assistance. Option D. Utilize NLP to automatically categorize customer complaints for immediate escalation without human validation. The correct answer is B. Implement NLP for sentiment analysis and topic extraction, with a protocol for human review of flagged interactions to validate insights and inform process improvements. Explanation: scenario analysis. This scenario presents a common challenge in financial services, balancing technological innovation with regulatory compliance and customer trust. The introduction of natural language processing, NLP, for customer interaction analysis promises operational efficiencies, but it also introduces risks related to data privacy, accuracy of interpretation, and potential for bias. The professional challenge lies in selecting an NLP implementation strategy that maximizes benefits while rigorously adhering to the regulatory framework governing financial services, specifically in the context of the LOMA 335 exam's jurisdiction. This requires a nuanced understanding of how NLP outputs are used and the potential impact on customer data and service delivery. Correct approach analysis. The correct approach involves implementing NLP for sentiment analysis and topic extraction, with a clear protocol for human review of flagged interactions. This is the most professionally sound strategy because it directly addresses the core benefits of NLP, efficiency in identifying trends and issues, while mitigating the inherent risks. The human review component is critical for ensuring accuracy, preventing misinterpretations that could lead to incorrect business decisions or customer dissatisfaction, and crucially, for maintaining compliance with data protection and fair treatment regulations. By focusing on insights that inform process improvement and agent training, rather than direct, automated customer action based solely on NLP output, the firm stays within acceptable risk parameters. This approach aligns with the principle of operational excellence by seeking continuous improvement through data-driven insights, while upholding ethical standards of accuracy and customer care. Incorrect approaches analysis. Implementing NLP for automated customer service responses based solely on sentiment analysis is professionally unacceptable. This approach fails to account for the nuances of human language and emotion, which NLP, even advanced models, can misinterpret. Such misinterpretations could lead to inappropriate or unhelpful responses, damaging customer relationships and potentially violating consumer protection regulations that mandate clear and accurate communication. Furthermore, relying solely on automated responses without human oversight bypasses critical quality control mechanisms. Deploying NLP to automatically categorize customer complaints for immediate escalation without a human validation step is also professionally unsound. While the intention might be to speed up resolution, the risk of miscategorization is high. Incorrectly escalating a minor issue or failing to escalate a critical one due to NLP error can lead to significant operational failures, regulatory breaches related to complaint handling timelines and fairness, and reputational damage. The lack of a human check introduces an unacceptable level of error into a sensitive process. Utilizing NLP to analyze customer feedback for marketing campaign optimization without considering data privacy implications is a serious ethical and regulatory failing. Customer feedback, even if anonymized, may contain sensitive information. Without a robust framework for data handling, consent, and anonymization that complies with relevant privacy laws, this approach risks data breaches and violations of customer trust, which are strictly prohibited. Operational excellence demands that efficiency gains do not come at the expense of fundamental data protection principles. Professional reasoning. Professionals facing such a decision must adopt a risk-based approach, prioritizing regulatory compliance and customer well-being alongside operational efficiency. The decision-making process should involve a thorough assessment of the potential benefits of NLP against the identified risks, considering the specific regulatory requirements of the financial services industry. This includes evaluating the accuracy limitations of NLP, the potential for bias, and the implications for data privacy and security. A phased implementation, starting with less critical applications and incorporating human oversight, is often prudent. Furthermore, Continuous monitoring and auditing of NLP systems are essential to ensure ongoing compliance and effectiveness. The ultimate goal is to leverage technology to enhance operational excellence without compromising ethical standards or regulatory obligations. Question 4. Compliance review shows that the firm's operational teams are primarily focused on meeting service-level agreements and cost targets, with limited formal processes for identifying, assessing, and escalating potential risks that could impact service delivery or financial stability. Which of the following approaches best aligns with regulatory expectations for operational excellence in financial services? Option A. Acknowledge the finding as a low-priority administrative issue and instruct operational teams to continue focusing on their primary performance metrics. Option B. Implement a reactive risk management strategy where operational teams report issues only after they have occurred and caused a disruption. Option C. Develop and implement a risk management framework that integrates risk identification, assessment, and mitigation strategies directly into operational workflows and decision-making processes, supported by regular training for operational staff. Option D. Establish a dedicated risk management department that will solely be responsible for identifying and managing all operational risks, with minimal direct involvement from operational teams. Correct answer is C. Develop and implement a risk management framework that integrates risk identification, assessment, and mitigation strategies directly into operational workflows and decision-making processes, supported by regular training for operational staff. Explanation. This scenario is professionally challenging because it requires balancing operational efficiency with robust risk management, a core tenet of operational excellence in financial services. The compliance review highlights a potential gap in the firm's ability to proactively identify and mitigate risks arising from its core operational processes. The pressure to maintain service levels and cost-effectiveness can sometimes lead to overlooking or downplaying emerging risks, making a structured and compliant approach essential. The correct approach involves implementing a comprehensive risk assessment framework that is integrated into the daily operations and decision-making processes. This means not only identifying potential risks, but also quantifying their impact, assessing their likelihood, and establishing clear mitigation strategies and controls. Regulatory frameworks, such as those governing financial services operations, mandate that firms have effective systems and controls in place to manage risks. This proactive and integrated approach ensures that risks are addressed before they materialize into significant issues, thereby safeguarding the firm's financial stability, reputation, and customer trust. It aligns with the principles of operational excellence by embedding risk management as a continuous improvement activity. An incorrect approach would be to dismiss the compliance finding as a minor administrative issue. This fails to recognize the potential systemic impact of unmanaged operational risks. Regulatory frameworks require firms to take a serious view of compliance findings and to implement corrective actions promptly. Another incorrect approach would be to focus solely on reactive measures, such as addressing issues only after they have caused a disruption. This is contrary to the principles of proactive risk management and can lead to significant financial losses, regulatory penalties, and reputational damage. It demonstrates a lack of commitment to operational excellence and a failure to meet regulatory expectations for robust risk governance. A third incorrect approach would be to delegate risk management solely to a separate department without embedding it into operational workflows. While specialized risk teams are important, operational staff are on the front lines and must be empowered and trained to identify and report risks within their daily tasks. This siloed approach can lead to a disconnect between risk identification and operational execution, hindering effective risk mitigation. Professionals should approach such situations by first understanding the specific regulatory requirements related to risk management in financial operations. This involves consulting relevant guidance and frameworks. They should then conduct a thorough root cause analysis of the compliance finding to understand the underlying issues. Based on this analysis, they should develop a remediation plan that includes both immediate corrective actions and long-term strategic improvements to the risk management framework. This plan should be communicated to relevant stakeholders and progress should be monitored regularly. The decision-making process should prioritize compliance, risk mitigation, and the long-term sustainability of the firm's operations. Question 5. Strategic planning requires that agile teams within financial services organizations effectively integrate regulatory compliance into their sprint planning process. Considering the operational excellence objectives of the LOMA 335 exam, which of the following approaches best ensures that sprint goals are achieved while adhering to all applicable regulatory frameworks? Option A. Delegate the responsibility for regulatory compliance to a separate team that reviews completed work at the end of each sprint. Option B. Assume that existing team knowledge of regulations is sufficient and proceed with sprint planning without explicit consultation with compliance or legal departments. Option C. Proactively identify, document, and incorporate all relevant regulatory requirements into sprint backlog items and user stories during the sprint planning meeting. Option D. Prioritize business value and speed of delivery, addressing regulatory compliance only if issues arise during testing or deployment. The correct answer is D. Prioritize business value and speed of delivery, addressing regulatory compliance only if issues arise during testing or deployment. Explanation: this scenario is professionally challenging because it requires balancing the need for rapid progress and adaptability inherent in agile methodologies with the stringent regulatory compliance obligations faced by financial services firms. Sprint planning, a core agile practice, must be executed in a way that not only delivers value, but also ensures adherence to all applicable laws and guidelines. The pressure to deliver quickly can sometimes lead to shortcuts that inadvertently compromise compliance. Careful judgment is required to integrate regulatory considerations seamlessly into the sprint planning process without hindering efficiency. The correct approach involves proactively identifying and incorporating regulatory requirements into the sprint backlog and user stories from the outset. This means that during sprint planning, the team dedicates time to understanding the compliance implications of the work planned for the sprint. This approach is correct because it aligns with the principle of compliance by design, which is a fundamental expectation in regulated industries. By embedding regulatory considerations into the planning phase, the team can anticipate potential issues, allocate necessary resources for compliance checks, and ensure that the developed features or processes meet all legal and ethical standards. This proactive stance minimizes the risk of costly rework or regulatory breaches later in the development lifecycle. An incorrect approach that focuses solely on delivering features based on business priority without explicit consideration of regulatory impact is professionally unacceptable. This failure stems from a disregard for the regulatory framework governing financial services. Such an approach risks developing solutions that, while meeting business needs, may violate data privacy laws, anti-money laundering regulations, or consumer protection rules. This can lead to significant fines, reputational damage, and legal action. Another incorrect approach that delegates regulatory review solely to the end of the sprint or project is also professionally flawed. This reactive stance creates a bottleneck and increases the likelihood of discovering compliance issues late in the process, necessitating extensive and often disruptive changes. It fails to uphold the ethical responsibility of ensuring that all operations are conducted within the bounds of the law and regulatory guidance, potentially exposing the firm to undue risk. A third incorrect approach that assumes existing regulatory knowledge is sufficient without seeking clarification or engaging compliance experts when new or complex features are planned is also problematic. This can lead to misinterpretations of regulations or overlooking subtle but critical compliance nuances, demonstrates a lack of due diligence and a failure to proactively manage regulatory risk, which is a core professional responsibility in financial services. Professionals should adopt a decision-making framework that prioritizes a holistic view of sprint planning. This involves 1. Understanding the regulatory landscape relevant to the plan work. 2. Collaborating closely with compliance officers and legal counsel during backlog refinement and sprint planning. 3. Ensuring that user stories and acceptance criteria explicitly include regulatory compliance requirements. 4. Building in time for regulatory reviews and testing within the sprint. 5. Fostering a culture where regulatory adherence is seen as an integral part of operational excellence, not an afterthought. Question 6. Research into a financial services firm's internal audit revealed a significant operational deficiency that, if publicly disclosed, could negatively impact the company's stock price. A compliance officer, privy to this information, is considering whether to sell their personal holdings in the company before the information becomes public. What is the most appropriate course of action for the compliance officer? Option A. Discuss the audit findings with trusted colleagues to gauge their opinions on the severity of the issue and potential market impact. Option B. Sell personal stock holdings to mitigate potential financial losses before the information is disclosed to the market. Option C. Immediately report the findings through the company's established internal compliance channels for review and potential regulatory disclosure, and refrain from any personal trading activity until the information is public. Option D. Wait for the company's management to decide on the disclosure timeline before taking any action regarding personal investments. The correct answer is C. Immediately report the findings through the company's established internal compliance channels for review and potential regulatory disclosure, and refrain from any personal trading activity until the information is public. Explanation: this scenario presents a professional challenge because it requires balancing the company's immediate financial interests with its long-term ethical and regulatory obligations. The compliance officer is privy to information that, if acted upon improperly, could lead to significant legal repercussions and reputational damage for the firm. The core of the challenge lies in navigating the gray area between internal reporting, potential market manipulation, and the duty to act with integrity. Careful judgment is required to ensure that all actions are transparent, legal, and uphold the principles of fair market conduct. The correct approach involves immediately escalating the information through the designated internal channels for compliance review and potential regulatory reporting, without taking any personal action that could be construed as insider trading or market manipulation. This upholds the regulatory framework by ensuring that potentially material non-public information is handled according to established procedures, which are designed to prevent unfair advantages and maintain market integrity. Ethically, it demonstrates a commitment to transparency and responsible corporate behavior. This approach aligns with the principles of operational excellence by prioritizing robust compliance mechanisms and risk mitigation. An incorrect approach would be to delay reporting the information or to attempt to profit from it before it becomes public. Delaying reporting could be seen as a failure to comply with regulatory requirements for timely disclosure of material information, potentially leading to penalties for the firm and the individual. Attempting to profit from this information before it is public constitutes insider trading, a serious violation of securities laws and ethical standards. This action directly undermines market fairness and the trust placed in financial professionals. Another incorrect approach would be to discuss the information with colleagues outside of the official compliance reporting structure, even if with good intentions, such as seeking advice. This could inadvertently lead to a wider dissemination of material non-public information, increasing the risk of leaks and potential insider trading by others. It bypasses the controlled and documented process designed for handling such sensitive information, creating an uncontrolled information flow that is inherently risky from a compliance perspective. The professional decision-making process for similar situations should involve a clear understanding of the company's internal policies and procedures for handling material non-public information. Professionals must be aware of their reporting obligations under relevant regulations. When faced with such a dilemma, the immediate step should be to consult the compliance department or legal counsel. The focus should always be on adhering to established protocols, ensuring transparency, and avoiding any action that could create a conflict of interest or violate regulatory mandates. Prioritizing ethical conduct and regulatory compliance over personal or immediate company gain is paramount. Question 7. To address the challenge of operational excellence initiatives inadvertently creating regulatory pain points, a financial services firm is considering several approaches to implementing new automated underwriting processes. Which of the following approaches best aligns with regulatory compliance and operational risk management principles? Option A. Conduct a comprehensive review of existing underwriting processes to identify potential compliance gaps and data integrity risks before implementing automation, and design the automated system with embedded compliance checks and audit trails. Option B. Delegate the responsibility for compliance oversight of the new automated system to the IT department, without direct involvement from the compliance or legal teams during the design phase. Option C. Implement automation with a primary focus on reducing operational costs, assuming that existing compliance controls will adequately cover the new processes. Option D. Prioritize the rapid deployment of the automated underwriting system to gain a competitive advantage, addressing any compliance issues that may arise after the system is fully operational. The correct answer is A. Conduct a comprehensive review of existing underwriting processes to identify potential compliance gaps and data integrity risks before implementing automation, and design the automated system with embedded compliance checks and audit trails. Explanation. Scenario analysis. This scenario presents a common pain point in financial services: the risk of operational failures leading to regulatory breaches and customer harm. The challenge lies in balancing the need for efficiency and cost reduction with the imperative to maintain robust compliance and customer protection. Professionals must exercise careful judgment to identify and mitigate these risks proactively, ensuring that operational improvements do not inadvertently create new vulnerabilities or compromise existing controls. The pressure to achieve business objectives can sometimes obscure the critical importance of regulatory adherence, making it a professionally demanding situation. Correct approach analysis. The correct approach involves a comprehensive review of existing operational processes, specifically identifying areas where automation or streamlining might inadvertently reduce oversight or introduce new compliance gaps. This approach is right because it directly addresses the potential for operational excellence initiatives to create regulatory pain points. By proactively assessing the impact of changes on compliance controls, data integrity, and customer data protection, financial institutions can ensure that automation enhances, rather than erodes, their regulatory standing. This aligns with the principles of operational risk management and the regulatory expectation for firms to have effective systems and controls in place to prevent breaches of regulatory requirements, such as those outlined in the LOMA 335 framework's emphasis on sound business practices and compliance. Incorrect approach is analysis. Implementing automation without a thorough assessment of its impact on regulatory compliance is an incorrect approach. This failure stems from prioritizing efficiency over risk management, potentially leading to breaches of data privacy regulations, anti-money laundering (AML) requirements, or consumer protection laws. The absence of a compliance impact assessment means that new operational processes might not adequately capture or report on required data, or might bypass necessary checks and balances, creating significant regulatory exposure. Focusing solely on cost reduction without considering the operational and compliance implications is also an incorrect approach. This narrow focus can lead to the implementation of solutions that, while cheaper, are less robust in terms of security, data integrity, or adherence to regulatory reporting standards. The ethical failure here is a disregard for the firm's duty to protect customer assets and data, and to operate within the bounds of the law. Adopting a wait-and-see approach, addressing compliance issues only after they arise, is fundamentally flawed and professionally unacceptable. This reactive stance demonstrates a lack of proactive risk management and a failure to uphold the principle of conduct risk, the risk that a firm's behavior will result in poor outcomes for customers. Regulatory bodies expect financial institutions to anticipate and mitigate risks, not to merely react to failures, which can result in significant fines, reputational damage, and loss of customer trust. Professional reasoning. Professionals should adopt a risk-based approach to operational excellence. This involves 1. Identifying potential pain points by mapping current processes and understanding their regulatory touchpoints. 2. Assessing the impact of proposed operational changes on these regulatory touchpoints, including data flows, control mechanisms, and reporting requirements. 3. Designing and implementing changes with built-in compliance checks and balances. 4. Establishing ongoing monitoring and review mechanisms to ensure that operational improvements remain compliant and effective over time. This systematic process ensures that operational excellence is achieved without compromising regulatory obligations or customer interests. Question 8. Analysis of the operational performance of a financial services firm reveals a focus on metrics that primarily measure the speed of internal processing. While these metrics show improvements in efficiency, there is a concurrent rise in customer complaints related to errors and a lack of clarity in service delivery. Considering the regulatory framework for financial services in the United States, which of the following approaches to key performance indicators KPI best aligns with the principles of operational excellence and risk management? Option A. Implement a balanced set of KPIs that include measures of accuracy, customer satisfaction, compliance adherence, and the reduction of operational errors, alongside efficiency metrics. Option B. Continue to prioritize KPIs that solely measure the speed of internal transaction processing, as this directly contributes to cost reduction and overall throughput. Option C. Focus on KPIs that measure the volume of services delivered, assuming that higher volume inherently indicates better operational performance and customer satisfaction. Option D. Develop KPIs that are easily quantifiable and reportable, even if they do not directly correlate with risk mitigation or customer experience outcomes. The correct answer is A. Implement a balanced set of KPIs that include measures of accuracy, customer satisfaction, compliance adherence, and the reduction of operational errors, alongside efficiency metrics. Explanation: this scenario is professionally challenging because it requires balancing the need for robust operational efficiency with the imperative to comply with regulatory expectations regarding risk management and customer protection. The pressure to demonstrate immediate improvements can lead to a temptation to oversimplify or misinterpret KPI data, potentially masking underlying issues. Careful judgment is required to ensure that KPIs are not only measurable, but also meaningful and aligned with strategic objectives and regulatory mandates. The correct approach involves selecting and monitoring KPIs that directly reflect the effectiveness of operational processes in mitigating risks and ensuring customer outcomes, as mandated by regulatory frameworks such as those governing financial services in the United States. Specifically, focusing on KPIs that measure the accuracy and timeliness of customer complaint resolution, the reduction in operational errors leading to financial losses, and the adherence to compliance procedures provides a comprehensive view of operational excellence from a risk and customer-centric perspective. This aligns with regulatory expectations that financial institutions proactively identify, assess, and manage risks, and that their operations are conducted in a manner that protects consumers. For instance, the Securities and Exchange Commission (SEC) and the Financial Industry Regulatory Authority (FINRA) emphasize the importance of robust compliance programs and effective risk management systems, which are directly reflected in KPIs related to error rates and complaint handling. An incorrect approach would be to prioritize KPIs that solely focus on speed of service without adequately considering accuracy or customer impact. For example, measuring only the average call handling time without also tracking customer satisfaction or the resolution rate of issues raised during those calls could lead to a situation where representatives rush through interactions, potentially missing critical information or failing to resolve customer problems effectively. This could result in increased customer dissatisfaction and potential regulatory scrutiny for failing to adequately serve customers, which is a violation of consumer protection regulations enforced by bodies like the Consumer Financial Protection Bureau, CFPB. Another incorrect approach would be to focus on KPIs that measure internal process efficiency in isolation, without linking them to external risk events or customer outcomes. For instance, tracking the number of transactions processed per hour without considering the error rate or the number of subsequent customer inquiries or complaints related to those transactions would provide an incomplete picture. This could mask systemic issues that increase operational risk and negatively impact customers, contravening the principles of sound risk management and customer care expected by regulators. A further incorrect approach would be to select KPIs that are easily measurable but do not provide actionable insights into operational risks or customer experience. For example, tracking the number of system uptime hours without correlating it to the impact of any downtime on customer access to services or the ability of staff to perform their duties would be insufficient. Regulators expect financial institutions to understand the real-world impact of their operations, not just the theoretical performance of their systems. The professional decision-making process for similar situations should involve a systematic evaluation of potential KPIs against the organization's strategic goals, risk appetite, and regulatory obligations. This includes understanding how each KPI can be used to identify, measure, and manage operational risks and improve customer outcomes. Professionals should consult relevant regulatory guidance and industry best practices to ensure that chosen KPIs are comprehensive and effective. Furthermore, a continuous review and refinement process for KPIs is essential to adapt to evolving business needs and regulatory landscapes. Question 9. The investigation demonstrates that a new automated claims processing system is projected to significantly reduce operational costs and processing times. However, preliminary reviews indicate that the system's data validation protocols may not fully align with specific data retention and reporting requirements mandated by the relevant financial services regulatory framework. Which approach best embodies the principles of operational excellence in this context? Option A. Prioritize the speed of implementation to gain a competitive advantage, assuming that regulatory bodies will be understanding of the efficiency gains achieved. Option B. Proceed with the implementation of the new system immediately to realize cost savings and address any potential regulatory discrepancies in a subsequent phase. Option C. Conduct a thorough impact assessment to identify all potential regulatory compliance gaps and develop a remediation plan to address them before system go live. Option D. Delegate the responsibility for ensuring regulatory compliance of the new system to the IT department, as they are responsible for system functionality. The correct answer is B. Proceed with the implementation of the new system immediately to realize cost savings and address any potential regulatory discrepancies in a subsequent phase. Explanation. The investigation demonstrates a common challenge in financial services, balancing the pursuit of operational excellence with the imperative of regulatory compliance. The scenario is professionally challenging because it requires a nuanced understanding of how efficiency gains might inadvertently create new risks or exacerbate existing ones, potentially leading to breaches of regulatory requirements. Careful judgment is required to ensure that improvements are sustainable and do not compromise the integrity of client data, fair treatment of customers, or the overall stability of the firm's operations, all of which are core tenets of operational excellence as defined within the LOMA 335 framework. The correct approach involves a comprehensive impact assessment that systematically evaluates potential operational changes against established regulatory frameworks and internal control policies. This approach prioritizes identifying and mitigating any adverse effects on compliance, risk management, and customer outcomes before implementation. Specifically, it requires a thorough review of how proposed changes might affect data security, privacy, reporting accuracy, and adherence to consumer protection laws. This aligns with the LOMA 335 emphasis on operational excellence as a holistic concept that integrates efficiency with robust governance and risk management, ensuring that improvements do not create new vulnerabilities or violate the spirit and letter of regulations. An incorrect approach that focuses solely on cost reduction without considering regulatory implications fails to acknowledge the fundamental principle that operational excellence must operate within a compliant environment. This approach risks introducing noncompliance, which can lead to significant fines, reputational damage, and loss of customer trust, directly contradicting the goals of sustainable operational excellence. Another incorrect approach that prioritizes speed of implementation over thorough risk assessment overlooks the critical need for due diligence. Rushing changes without adequate evaluation can lead to unforeseen operational failures, data breaches, or misstatements, all of which carry severe regulatory consequences and undermine the very definition of operational excellence. A further incorrect approach that delegates the assessment of regulatory impact to junior staff without adequate oversight or expertise is also professionally unacceptable. This demonstrates a failure in governance and risk management, as it assumes that regulatory compliance is a secondary concern or can be managed without senior accountability. This can lead to critical oversights and noncompliance, as regulatory frameworks are complex and require specialized knowledge. Professionals should employ a decision-making framework that begins with clearly defining the objectives of operational excellence initiatives. This should be followed by a rigorous impact assessment that includes a regulatory compliance review, a risk assessment, and an evaluation of customer outcomes. Any proposed changes must then be subjected to a thorough review by relevant stakeholders, including compliance and risk management departments, before approval and implementation. Continuous monitoring and post-implementation reviews are also essential to ensure ongoing adherence to both operational excellence goals and regulatory requirements. Question 10. During the evaluation of a new digital onboarding platform designed to enhance customer experience and operational efficiency, which of the following approaches best demonstrates a thorough assessment of the ADKAR model's effectiveness in driving successful adoption and achieving operational excellence within the regulatory framework of the Operational Excellence in Financial Services Exam LOMA 335? Option A. Relying solely on management's perception of employee readiness for the new platform, without direct employee feedback or objective performance data. Option B. Measuring the number of training sessions conducted for the new platform, assuming that attendance equates to successful knowledge transfer and adoption. Option C. Correlating employee survey responses about the platform with metrics on customer satisfaction and the reduction of onboarding errors, while also evaluating the development of necessary skills and the presence of ongoing support mechanisms. Option D. Assessing employee awareness of the new platform and their knowledge of its features through a single survey, without measuring their willingness to use it or their ability to do so effectively. Correct answer is D. Assessing employee awareness of the new platform and their knowledge of its features through a single survey, without measuring their willingness to use it or their ability to do so effectively. Explanation. This scenario is professionally challenging because it requires balancing the imperative of operational excellence, as emphasized in LOMA 335, with the practical realities of implementing significant change within a regulated financial services environment. The ADKAR model, a framework for managing individual change, is being applied to a large-scale initiative. The challenge lies in ensuring that the application of ADKAR is not merely a procedural step, but a genuine driver of successful adoption and sustained operational improvement, while adhering to regulatory expectations for responsible business conduct and customer protection. Careful judgment is required to assess the effectiveness of the change management strategy and its alignment with broader organizational goals and regulatory compliance. The correct approach involves a comprehensive assessment of each ADKAR component: awareness, knowledge, desire, ability, reinforcement, through a combination of qualitative and quantitative methods, directly linked to observable behaviors and business outcomes. This approach is right because it provides a robust, data-driven evaluation of the change initiative's progress and identifies specific areas for intervention. Regulatory frameworks in financial services, such as those governing consumer protection and operational resilience, implicitly require that changes implemented lead to improved, not degraded, service delivery and risk management. Demonstrating that the ADKAR model has been effectively applied and has led to successful adoption of new processes or systems supports the firm's commitment to operational excellence and regulatory compliance, by ensuring that changes are embedded and contribute positively to the business and its stakeholders. An approach that focuses solely on the awareness and knowledge stages, while neglecting desire, ability, and reinforcement, is incorrect. This failure to address the motivational and practical aspects of change can lead to superficial adoption, where employees may be aware of the change and know what to do, but lack the will or the skills to implement it effectively, or the reinforcement to sustain it. This can result in operational inefficiencies, increased errors, and potential noncompliance with regulations that mandate effective operational processes and customer service standards. An approach that relies exclusively on employee feedback surveys without correlating this feedback to actual behavioral changes or operational metrics is also incorrect. While feedback is valuable, it does not, on its own, prove successful adoption or operational improvement. This can lead to a false sense of progress, masking underlying issues that could result in regulatory breaches or operational failures. Finally, an approach that prioritizes the speed of implementation over the thoroughness of ADKAR assessment is incorrect. Rushing through the change process without adequately ensuring individual readiness and reinforcement increases the risk of incomplete adoption, leading to operational breakdowns, increased risk exposure, and potential regulatory sanctions. The professional decision-making process for similar situations should involve a structured, multifaceted evaluation of change initiatives. This includes defining clear metrics for each ADKAR element that are tied to observable behaviors and business results. Professionals should actively seek evidence of adoption and its impact on operational efficiency and risk management, rather than relying on assumptions or incomplete data. Regular review and adjustment of the change management strategy based on this evidence are crucial for ensuring that operational excellence is achieved and regulatory expectations are met. Question 11. The control framework reveals a significant increase in processing time for new policy applications. To address this identified waste, which of the following actions is most aligned with the principles of operational excellence and regulatory expectations for efficient financial services operations? Option A. Immediately authorize extensive overtime for all policy processing staff to clear the backlog of applications. Option B. Conduct a detailed process mapping exercise to identify non-value-adding steps and bottlenecks in the application workflow, followed by targeted improvements to eliminate identified waste. Option C. Implement a new, more complex software system for application processing to potentially speed up individual data entry tasks. Option D. Hire additional temporary staff to handle the increased volume of applications without analyzing current workflow inefficiencies. The correct answer is B. Conduct a detailed process mapping exercise to identify non-value-adding steps and bottlenecks in the application workflow, followed by targeted improvements to eliminate identified waste. Explanation. The control framework reveals a significant increase in processing time for new policy applications, indicating potential waste in operational workflows. This scenario is professionally challenging because it directly impacts customer satisfaction, operational efficiency, and potentially regulatory compliance if delays lead to breaches of service-level agreements or statutory timeframes. The need for careful judgment arises from balancing the urgency of addressing waste with the need to maintain the integrity and effectiveness of control mechanisms. The correct approach involves a systematic root cause analysis of the processing delays, focusing on identifying and eliminating non-value-adding activities, MUTA, within the application workflow. This aligns with the principles of operational excellence and regulatory expectations for efficient and effective service delivery. Specifically, under the operational excellence framework relevant to financial services, identifying and reducing waste is a core tenet. This approach is ethically sound as it prioritizes customer experience and efficient use of resources, which are implicit expectations in regulated financial services. It also supports the company's commitment to operational integrity, a key aspect of regulatory compliance. An incorrect approach would be to immediately implement a blanket policy of overtime for all processing staff. This fails to address the underlying causes of the delay and can lead to increased costs, burnout, and potential errors due to fatigue, thereby introducing new forms of waste and operational risk. It bypasses the critical step of understanding why the delays are occurring, which is essential for sustainable improvement and compliance with operational efficiency mandates. Another incorrect approach would be to simply increase staffing levels without analyzing the workflow. This is a reactive measure that does not address potential inefficiencies in the existing processes. It can lead to higher operational costs and may not resolve the root cause of the waste, potentially masking deeper systemic issues that could later manifest in other areas, impacting the firm's ability to meet its operational obligations and regulatory standards for prudent management. A further incorrect approach would be to focus solely on the speed of individual tasks without considering the overall process flow and customer journey. This narrow focus can lead to optimizing one part of the process at the expense of others, creating bottlenecks elsewhere, and failing to achieve true operational excellence. It neglects the holistic view required by regulatory bodies to ensure end-to-end efficiency and customer protection. The professional decision-making process should involve 1. Acknowledging the observed waste, increased processing time. 2. Initiating a structured investigation to identify the specific types of waste, e.g., waiting, unnecessary motion, defects within the application process. 3. Prioritizing the elimination of identified waste through process improvement initiatives. 4. Monitoring the impact of these initiatives on processing times and overall operational efficiency. 5. Ensuring all improvements are documented and align with the firm's internal control framework and any applicable regulatory guidance on operational resilience and efficiency. Question 12. System analysis indicates that a financial services firm is seeking to enhance its operational risk identification processes. Which of the following approaches would be most effective in achieving comprehensive and proactive risk identification within the regulatory framework for operational excellence? Option A. focusing solely on identifying and documenting risks that have the potential for significant financial loss or regulatory fine, ignoring smaller, recurring issues. Option B, relying exclusively on a review of past operational incident reports and claims data to identify patterns and potential future risks. Option C, outsourcing the entire risk identification process to a third-party risk management consultancy without significant internal involvement or validation. Option D, implementing a continuous monitoring system that analyzes operational data in real time, supplemented by regular workshops with frontline staff to gather qualitative insights on potential emerging risks. The correct answer is D, implementing a continuous monitoring system that analyzes operational data in real time, supplemented by regular workshops with frontline staff to gather qualitative insights on potential emerging risks. Explanation: this scenario presents a professional challenge because the financial services firm is attempting to identify risks within a complex, evolving operational environment. The challenge lies in ensuring that the risk identification process is comprehensive, proactive, and aligned with regulatory expectations for operational excellence, rather than being a reactive or superficial exercise. Careful judgment is required to select an approach that effectively uncovers potential vulnerabilities before they manifest as significant issues. The correct approach involves a structured, multifaceted methodology that integrates various data sources and perspectives to identify potential operational risks. This includes not only reviewing historical incident data, but also actively engaging with frontline staff, conducting scenario planning, and leveraging technology for continuous monitoring. This approach is correct because it aligns with the principles of robust risk management expected in the financial services industry, aiming to identify risks across different dimensions of the operation. Specifically, regulatory frameworks for operational excellence, such as those emphasized in LOMA 335, mandate a proactive and thorough approach to risk identification. This includes understanding the firm's specific operational processes, the external environment, and the potential impact of identified risks. Ethical considerations also demand that firms act diligently to protect their customers and stakeholders by identifying and mitigating risks. An incorrect approach that relies solely on historical incident data fails to identify emerging or latent risks that have not yet resulted in documented incidents. This is a regulatory failure because it is insufficient for demonstrating a commitment to proactive risk management and operational resilience. It also presents an ethical failure by potentially leaving the firm exposed to unforeseen events that could harm customers. Another incorrect approach that focuses only on high-profile, catastrophic risks overlooks the cumulative impact of smaller, more frequent operational failures. This is a regulatory failure as it neglects a significant portion of the operational risk landscape, potentially leading to a false sense of security. Ethically, it fails to uphold the duty of care to manage all material risks, regardless of their perceived severity in isolation. A third incorrect approach that delegates risk identification entirely to an external audit firm without internal engagement is also flawed. While external audits provide valuable independent perspectives, they cannot fully capture the nuanced, day-to-day operational realities and internal knowledge held by the firm's employees. This can lead to a superficial understanding of risks and is a regulatory failure because it suggests a lack of internal ownership and expertise in risk management. Ethically, it may indicate a disengagement from the firm's core responsibility to manage its own operations effectively. The professional decision-making process for similar situations should involve a commitment to a comprehensive and integrated risk identification framework. This framework should prioritize understanding the firm's specific operational context, actively seeking input from all relevant levels of the organization, and utilizing a combination of historical data analysis, forward-looking assessments, and continuous monitoring. Professionals should critically evaluate any proposed risk identification methodology to ensure it is robust, proactive, and demonstrably aligned with regulatory expectations for operational excellence and ethical conduct. Question 13. Comparative studies suggest that implementing a new data governance framework can significantly alter operational workflows. Which of the following approaches best ensures that a financial services firm maintains operational excellence and regulatory compliance during such an implementation? Option A. Prioritize the technical implementation of data security and storage solutions, assuming business processes will adapt accordingly. Option B. Expedite the implementation timeline to achieve operational efficiencies quickly, deferring detailed impact analysis to a later stage. Option C. Proceed with the implementation of the new framework, relying on existing operational procedures to manage any unforeseen changes. Option D. Conduct a comprehensive impact assessment to identify and address all potential effects on processes, systems, personnel, and regulatory obligations before full implementation. The correct answer is D. Conduct a comprehensive impact assessment to identify and address all potential effects on processes, systems, personnel, and regulatory obligations before full implementation. Explanation. This scenario is professionally challenging because it requires a financial services firm to balance the immediate need for operational efficiency with the long-term imperative of robust data governance, all within the specific regulatory landscape of the Operational Excellence in Financial Services Exam LOMA 335. The firm must assess the impact of a new data governance framework on existing processes, systems, and personnel, ensuring compliance with relevant regulations without unduly hindering business operations. Careful judgment is required to prioritize implementation steps and allocate resources effectively. The correct approach involves conducting a comprehensive impact assessment that systematically identifies all potential effects of the new data governance framework. This includes evaluating how the framework will alter data collection, storage, processing, and security procedures. It also necessitates understanding the implications for regulatory reporting, risk management, and customer data privacy. This approach is correct because it aligns with the principles of operational excellence by proactively identifying and mitigating risks associated with change, ensuring that the new framework is implemented in a controlled and compliant manner. Specifically, it supports the regulatory requirement to maintain sound operational and risk management practices, as mandated by frameworks governing financial services operations, by ensuring that data governance changes are well understood and managed. An incorrect approach would be to proceed with implementing the data governance framework without a thorough impact assessment, assuming that existing processes are sufficient. This fails to acknowledge the potential for unintended consequences, such as data breaches, compliance violations, or operational disruptions. Such an approach risks violating regulatory obligations to maintain adequate controls and safeguards for data. Another incorrect approach would be to focus solely on the technical aspects of data governance, such as database architecture and security protocols, while neglecting the impact on business processes and personnel. This oversight can lead to resistance from staff, inefficient workflows, and a failure to achieve the intended benefits of the governance framework. It neglects the human element and the practical application of governance, which is crucial for operational excellence and regulatory adherence. A further incorrect approach would be to prioritize speed of implementation over thoroughness, rushing the impact assessment and deployment. This haste can lead to critical risks being overlooked, potentially resulting in significant financial penalties, reputational damage, and a loss of customer trust. It undermines the principle of operational excellence by sacrificing quality and control for expediency. The professional decision-making process for similar situation should involve a phased approach. First, clearly define the objectives and scope of the data governance framework. Second, conduct a detailed impact assessment across all relevant business units, systems, and processes, involving stakeholders from IT, compliance, legal, and operations. Third, develop a phased implementation plan based on the assessment findings, prioritizing critical areas and addressing identified risks. Fourth, establish clear metrics for monitoring the effectiveness of the framework and ensuring ongoing compliance. Finally, regularly review and update the framework in response to evolving business needs and regulatory changes. Question 14. Market research demonstrates a consistent decline in customer satisfaction scores for a key financial product. Senior management is pressuring the operational excellence team to quickly improve these scores to meet performance targets. The team identifies that a significant portion of negative feedback relates to the complexity of the product's terms and conditions, which are legally mandated and cannot be simplified. The team is considering several approaches to address the situation. Which of the following approaches best aligns with the principles of operational excellence and regulatory expectations for financial services firms? Option A. Focus solely on improving response times for customer inquiries, as faster service is often perceived positively, and downplay the importance of the product's complex terms and conditions in customer communications. Option B. Develop a clear, concise summary of the most critical aspects of the product's terms and conditions, highlighting key benefits and potential limitations in plain language, and proactively share this with customers, while also investing in enhanced customer support to explain the full terms. Option C. Implement a new, simplified product with slightly different features and market it as a superior alternative, while continuing to offer the existing complex product with minimal changes to its communication strategy. Option D. Instruct customer service representatives to guide customers towards selecting answers that reflect a more positive experience during satisfaction surveys, particularly when customers express mild dissatisfaction. The correct answer is B. Develop a clear, concise summary of the most critical aspects of the product's terms and conditions, highlighting key benefits and potential limitations in plain language, and proactively share this with customers, while also investing in enhanced customer support to explain the full terms. Explanation. This scenario presents a professional challenge because it pits the desire to improve customer satisfaction metrics against the ethical imperative to provide accurate and transparent information. The company is facing pressure to demonstrate progress, but the proposed method for achieving this would involve misleading customers. This requires careful judgment to balance business objectives with ethical conduct and regulatory compliance. The correct approach involves prioritizing transparency and genuine improvement in customer service over artificial inflation of satisfaction scores. This aligns with the principles of operational excellence by focusing on sustainable, customer-centric improvements rather than superficial gains. From a regulatory and ethical standpoint, this approach upholds the duty of care owed to customers and avoids deceptive practices, which are often prohibited by financial services regulations designed to protect consumers and maintain market integrity. Specifically, it adheres to principles of fair dealing and accurate representation of services and performance. An incorrect approach that involves manipulating survey responses or selectively reporting positive feedback would be ethically unsound and likely violate regulations. Such actions constitute deceptive practices, undermining customer trust and potentially leading to regulatory sanctions. Financial services regulators expect firms to operate with integrity and to provide accurate information to customers and the market. Another incorrect approach, which is to ignore the negative feedback and continue with existing processes, fails to address the underlying issues affecting customer satisfaction. While it avoids direct deception, it demonstrates a lack of commitment to operational excellence and customer well-being, potentially leading to long-term reputational damage and customer attrition. This passive approach neglects the responsibility to identify and rectify service deficiencies. A further incorrect approach, which is to implement superficial changes that do not address the root causes of customer dissatisfaction, is also problematic. While it might appear to be taking action, it is ultimately a form of misdirection. True operational excellence requires a deep understanding of customer needs and a commitment to making meaningful improvements, not just cosmetic ones. The professional decision-making process in such situations should involve 1. Identifying the core problem, low customer satisfaction. 2. Evaluating potential solutions against ethical principles and regulatory requirements. 3. Prioritizing solutions that offer genuine, sustainable improvements and uphold transparency. 4. Seeking to understand the root causes of dissatisfaction through honest feedback and data analysis. 5. Communicating openly with stakeholders about challenges and improvement plans. Question 15. Investigation of financial services firms' operational efficiency reveals significant delays in customer onboarding and policy administration. The firm is considering several strategies to address these issues and improve overall process performance. Which of the following approaches best aligns with the principles of operational excellence and regulatory compliance within the LOMA 335 framework? Option A. Rapidly deploying a new, cutting-edge customer relationship management (CRM) system acquired from a competitor, assuming it will automatically streamline all onboarding and administration processes. Option B. Initiating a significant reduction in operational staff across all departments to immediately lower overhead costs, with the expectation that remaining staff will adapt to increased workloads. Option C. Implementing a phased approach to process redesign, starting with a detailed analysis of current workflows, identifying key bottlenecks, and leveraging technology for automation and simplification, followed by rigorous testing and validation of proposed changes before full rollout. Option D. Adopting a competitor's entire operational workflow and technology stack without a thorough assessment of its suitability for the firm's specific regulatory environment and customer base. The correct answer is C. Implementing a phased approach to process redesign, starting with a detailed analysis of current workflows, identifying key bottlenecks, and leveraging technology for automation and simplification, followed by rigorous testing and validation of proposed changes before full rollout. Explanation. Scenario analysis. This scenario presents a common challenge in financial services, balancing the need for operational efficiency with regulatory compliance and customer protection. The core tension lies in streamlining processes to reduce costs and improve speed, while ensuring that these changes do not compromise the integrity of customer data, the fairness of service delivery, or adherence to LOMA 335 principles of operational excellence. Professionals must exercise careful judgment to identify process improvements that are both effective and compliant, avoiding shortcuts that could lead to regulatory breaches or reputational damage. Correct approach analysis. The correct approach involves a systematic review of existing processes to identify bottlenecks and redundancies, followed by the implementation of targeted improvements that leverage technology and best practices. This aligns with the LOMA 335 framework's emphasis on continuous improvement and operational excellence. Specifically, this approach prioritizes understanding the current state, mapping workflows, identifying areas for automation or simplification, and then testing and validating changes before full deployment. This methodical process ensures that efficiency gains are achieved without sacrificing accuracy, security, or compliance with relevant financial services regulations. The regulatory justification stems from the overarching requirement to maintain robust operational controls and to act in the best interests of customers, which necessitates well-designed and efficient, yet compliant processes. Incorrect approaches analysis. Implementing a new, unproven software solution without thorough testing or integration planning is an incorrect approach. This risks introducing new inefficiencies, data integrity issues, or security vulnerabilities, potentially leading to regulatory noncompliance and customer dissatisfaction. It bypasses the crucial validation steps required for operational excellence, focusing solely on reducing staff numbers to cut costs without analyzing the impact on process capacity or customer service is also an incorrect approach. This can lead to overburdened remaining staff, increased error rates, and a decline in service quality, which can violate regulatory expectations regarding customer care and operational resilience. Adopting a competitor's process verbatim without considering the specific regulatory environment, customer base, or existing technological infrastructure of the firm is another incorrect approach. This ignores the unique context of the organization and may lead to processes that are either non-compliant with local regulations or ineffective in the firm's specific operational setting. Professional reasoning. Professionals should approach process optimization by first conducting a comprehensive diagnostic of current operations. This involves mapping existing workflows, identifying key performance indicators, KPI, and gathering feedback from stakeholders. The next step is to design and pilot potential improvements, focusing on solutions that enhance efficiency while maintaining or improving compliance and customer experience. Rigorous testing, validation, and risk assessment are critical before full implementation. Continuous monitoring and iterative refinement are essential to sustain operational excellence. This structured, risk-aware, and compliance-focused methodology ensures that efficiency initiatives deliver tangible benefits without compromising the firm's integrity or regulatory standing. Question 16. The risk matrix shows a high likelihood of data corruption during the extraction, transformation, and loading ETL process for the company's primary customer relationship management, CRM data, which feeds into its core business intelligence, by platform. Which of the following actions best addresses this identified risk in accordance with operational excellence principles for financial services? Option A. Increase the frequency of BI report generation to identify and correct data anomalies more rapidly after they have impacted downstream reporting. Option B. Rely exclusively on the BI software's inherent data quality monitoring features, assuming they are sufficient to detect and rectify all ETL-related data corruption. Option C. Implement automated data validation rules and cleansing procedures at the point of data ingestion into the BI platform, alongside a robust data reconciliation process against source systems. Option D. Expedite the ETL process to ensure data is available for analysis as quickly as possible, with a plan to address any identified data quality issues in subsequent data refresh cycles. The correct answer is C. Implement automated data validation rules and cleansing procedures at the point of data ingestion into the BI platform, alongside a robust data reconciliation process against source systems. Explanation: the risk matrix shows a significant identified risk related to the accuracy and completeness of data feeding into the company's business intelligence by systems. This scenario is professionally challenging because operational excellence in financial services, as governed by LOMA 335, mandates robust data governance and integrity. Inaccurate or incomplete BI data can lead to flawed strategic decisions, misallocation of resources, regulatory breaches due to incorrect reporting, and ultimately, a failure to meet customer needs and maintain market competitiveness. The challenge lies in balancing the need for timely insights with the imperative of data quality and regulatory adherence. The correct approach involves implementing a comprehensive data validation and cleansing process before data is integrated into the BI system, coupled with ongoing monitoring and reconciliation. This aligns with the principles of operational excellence by ensuring the reliability of information used for decision-making. Regulatory justification stems from the implicit and explicit requirements within financial services regulations, as applicable to the LOMA 335 jurisdiction, that demand accurate record-keeping, reliable reporting, and sound risk management. BI systems are critical tools for fulfilling these obligations, and their inputs must therefore be trustworthy. An incorrect approach of relying solely on post-integration data anomaly detection fails to address the root cause of the risk. This is a regulatory failure because it allows potentially flawed data to influence business decisions and reporting, increasing the likelihood of material misstatements and non-compliance. It also represents an ethical failure as it compromises the integrity of the information provided to stakeholders. Another incorrect approach of prioritizing speed of data ingestion over data quality, with the intention of correcting errors later, is also a significant regulatory and ethical failure. This approach directly contravenes the principle of data integrity, which is fundamental to sound financial operations. It increases the risk of regulatory penalties, reputational damage, and poor business outcomes due to decisions based on unreliable data. A third incorrect approach of assuming that the BI vendor's built-in data quality checks are sufficient without independent verification is a failure of due diligence. While vendors provide tools, the ultimate responsibility for data accuracy rests with the financial institution. This oversight can lead to undetected data errors, resulting in regulatory noncompliance and operational inefficiencies. The professional decision-making process for similar situations should involve a proactive risk assessment, followed by the design and implementation of controls that address identified risks at their source. This includes establishing clear data governance policies, investing in data quality tools and processes, and ensuring continuous monitoring and improvement. Professionals must prioritize data integrity as a foundational element of operational excellence, understanding that reliable BI is a prerequisite for effective risk management and regulatory compliance. Question 17. The risk matrix shows a moderate to high likelihood of inconsistent application of new customer onboarding procedures across the retail banking and wealth management divisions due to differing legacy systems and established team practices. Which of the following approaches is most likely to achieve consistent operational excellence in implementing these new procedures? Option A. Issue a directive to all division heads to immediately implement the new procedures, with the expectation that each division will adapt them to their existing workflows. Option B. Allow each division to independently develop and implement their own version of the new procedures, provided they meet the minimum regulatory requirements. Option C. Develop a comprehensive, multi-phase implementation plan that includes tailored training for each division, clear communication of policy rationale, and ongoing performance monitoring with feedback loops. Option D. Invest in a new, centralized software system that automates the onboarding process, assuming this will enforce standardization across all divisions. Correct answer is C. Develop a comprehensive, multi-phase implementation plan that includes tailored training for each division, clear communication of policy rationale, and ongoing performance monitoring with feedback loops. Explanation. This scenario presents a common challenge in financial services, ensuring consistent application of operational policies across different business units, especially when those units have historically operated with some autonomy. The professional challenge lies in balancing the need for standardized, efficient operations with the practical realities of diverse team cultures, existing workflows, and varying levels of technological adoption. Achieving consistency is critical for regulatory compliance, risk management, and delivering a uniform customer experience, all of which are core tenets of operational excellence. Careful judgment is required to implement changes that are effective without causing undue disruption or resistance. The correct approach involves a phased, collaborative implementation strategy. This entails clearly communicating the rationale behind the new policy, providing comprehensive training tailored to each unit's needs, and establishing clear metrics for monitoring adherence and identifying areas requiring further support. This approach is correct because it directly addresses the core principles of operational excellence by promoting standardization and efficiency, while acknowledging the human element of change management. From a regulatory and ethical standpoint, this method ensures that all employees understand and can comply with established procedures, thereby mitigating operational risks and upholding the firm's commitment to integrity and customer service. It fosters a culture of accountability and continuous improvement, which are essential for long-term success and compliance. An incorrect approach would be to mandate the new policy with minimal communication and no tailored support. This fails to acknowledge the diverse operational environments within the firm and is likely to lead to inconsistent adoption, increased errors, and potential compliance breaches. Ethically, it demonstrates a lack of consideration for employees and can breed resentment, undermining the very operational excellence the firm aims to achieve. Another incorrect approach would be to allow each business unit to interpret and implement the policy independently. While this might seem to offer flexibility, it directly contradicts the goal of consistency. This approach would likely result in significant variations in operational processes, making it difficult to monitor risks, ensure regulatory compliance across the board, and maintain a unified customer experience. It creates a fragmented operational landscape, which is the antithesis of operational excellence. A third incorrect approach would be to focus solely on technological solutions to enforce the policy, without addressing the underlying human processes and training needs. Technology can be a powerful tool for consistency, but it is not a panacea. If employees do not understand the policy or are not equipped to use the technology effectively, the desired consistency will not be achieved. This approach overlooks the critical importance of people and process in operational excellence and can lead to frustration and workarounds that undermine the policy's intent. The professional decision-making process for similar situations should involve a thorough assessment of the current state, clear articulation of the desired future state, and a detailed plan for bridging the gap. This plan must include stakeholder engagement, robust communication, comprehensive training, and ongoing monitoring and feedback mechanisms. Professionals should prioritize approaches that foster collaboration, build understanding, and ensure that operational changes are sustainable and aligned with both business objectives and regulatory requirements. Question 18. The review process indicates a recurring pattern of customer complaints related to the processing of policy amendments, leading to delays and errors. The operational team is considering several approaches to address this issue. Which of the following approaches best aligns with the principles of operational excellence and a structured problem-solving framework for achieving sustainable improvement? Option A. Conduct a series of customer surveys to gather feedback on their dissatisfaction, and then implement a new customer service script to manage expectations. Option B. Initiate a DMAIC, define, measure, analyze, improve, control, project to thoroughly investigate the root causes of the delays and errors, develop targeted solutions, and establish controls to prevent recurrence. Option C. Implement a temporary staffing increase in the policy amendment department to clear the backlog and address immediate customer concerns. Option D. Authorize overtime for existing staff to work through the backlog of policy amendments and instruct supervisors to monitor output more closely. The correct answer is C. Implement a temporary staffing increase in the policy amendment department to clear the backlog and address immediate customer concerns. Explanation. The review process indicates a potential breakdown in a critical operational process within a financial services firm. This scenario is professionally challenging because it requires the immediate identification of the root cause of a recurring customer complaint and the implementation of a sustainable solution. Failure to address this effectively can lead to reputational damage, regulatory scrutiny, and financial losses. The core of the challenge lies in moving beyond superficial fixes to a systematic, data-driven approach that ensures long-term operational excellence. The correct approach involves a structured problem-solving methodology like DMAIC. This framework, when applied correctly, ensures that the problem is thoroughly defined, measured accurately, analyzed deeply, improved effectively, and controlled to prevent recurrence. Specifically, the define phase ensures the problem is clearly understood and scoped. The measure phase collects relevant data to establish a baseline. The analyze phase uses this data to identify the root cause, S. The improve phase develops and implements solutions to address these root causes. Finally, the control phase establishes mechanisms to sustain the improvements and monitor ongoing performance. This systematic, data-driven, and iterative process aligns with the principles of operational excellence and regulatory expectations for robust risk management and customer service. An incorrect approach would be to implement a quick fix without understanding the underlying cause. This often leads to recurring issues and demonstrates a lack of due diligence. For example, simply retraining staff without investigating why the initial training failed or why the process itself is flawed ignores the root cause and is unlikely to yield lasting results. This approach fails to meet the regulatory expectation of proactive risk identification and mitigation. Another incorrect approach is to focus solely on the symptoms of the problem, such as issuing apologies or offering compensation, without addressing the systemic issues that led to the complaints. This is a reactive measure that does not contribute to operational excellence and can be seen as a superficial attempt to appease customers without solving the core problem, potentially leading to further regulatory concerns regarding customer treatment. Professionals should employ a decision-making framework that prioritizes a systematic and data-driven approach to problem solving. When faced with operational issues, the first step should be to engage a recognized methodology like DMAIC. This involves clearly defining the problem, gathering objective data, rigorously analyzing that data to pinpoint root causes, developing and testing solutions, and finally, implementing controls to ensure sustained improvement. This structured approach not only addresses the immediate issue, but also builds a more resilient and efficient operational framework, aligning with the firm's commitment to operational excellence and regulatory compliance. Question 19. Risk assessment procedures indicate that a significant volume of customer personally identifiable information, PI, is stored within the company's core systems. To ensure operational excellence and compliance with data protection guidelines, what is the most appropriate approach to managing access controls for this sensitive data? Option A. Maintain existing access control policies that have been in place for several years, assuming they are still adequate for current data protection requirements. Option B. Grant broad access to all employees who have a general need to interact with customer data, as restricting access too much can hinder operational efficiency. Option C. Focus on the number of employees who have requested access and ensure that the system can handle the volume of concurrent users, as this is the primary indicator of operational need. Option D. Conduct a detailed impact assessment for each category of PII to determine the potential harm from unauthorized access, and then implement access controls commensurate with that assessed risk. The correct answer is D. Conduct a detailed impact assessment for each category of PII to determine the potential harm from unauthorized access, and then implement access controls commensurate with that assessed risk. Explanation. This scenario is professionally challenging because it requires balancing operational efficiency with robust security controls, specifically concerning access to sensitive customer data. The core tension lies in ensuring that employees have the necessary access to perform their duties without creating undue risk of unauthorized disclosure or modification of information, which is a critical aspect of operational excellence in financial services. The LOMA 335 exam emphasizes understanding and applying regulatory requirements and best practices to maintain customer trust and data integrity. The correct approach involves a comprehensive impact assessment that quantizes the potential harm resulting from unauthorized access to specific data elements. This aligns with regulatory expectations that organizations implement risk-based security measures. By understanding the sensitivity of data and the potential consequences of its compromise, the organization can prioritize and tailor access controls effectively. This proactive, data-driven approach ensures that resources are allocated to protect the most critical information, thereby meeting regulatory obligations for data protection and privacy, and fostering operational excellence by minimizing risk. An incorrect approach that focuses solely on the number of employees requiring access, without considering the sensitivity of the data or the potential impact of a breach, fails to adequately address the risk. This could lead to overly permissive access, increasing the likelihood of unauthorized disclosure and violating principles of data minimization and least privilege, which are often implicitly or explicitly required by financial services regulations. Another incorrect approach that prioritizes speed of access over security, by granting broad access to all employees without proper vetting or justification, directly contravenes the fundamental principles of information security and regulatory compliance. This approach creates significant vulnerabilities and exposes the organization to severe reputational and financial damage, undermining operational excellence. A further incorrect approach that relies on historical access levels without reevaluating current risks and data sensitivity is also flawed. Regulatory frameworks often require periodic reviews and updates of security controls to adapt to evolving threats and business needs. Failing to do so can result in outdated and ineffective access controls, leaving sensitive data exposed. The professional decision-making process for similar situations should involve a structured risk management framework. This includes identifying asset data, threats, unauthorized access, vulnerabilities, weak access controls, and potential impacts. The organization must then evaluate the likelihood and severity of these impacts to determine appropriate mitigation strategies, which in this case means implementing granular and risk-informed access controls. This process ensures that decisions are not arbitrary, but are grounded in a thorough understanding of risk and regulatory requirements, promoting operational excellence. Question 20. Assessment of a financial services firm's approach to a Six Sigma project aimed at reducing customer complaints related to account discrepancies, considering the firm operates under strict financial services regulations that mandate data privacy and accurate disclosure. The project team has identified several potential solutions, including streamlining reconciliation processes, enhancing data entry validation, and improving customer communication protocols. Which of the following approaches best aligns with operational excellence and regulatory compliance? Option A. Focus on immediate customer communication improvements to manage expectations, while temporarily halting further investigation into reconciliation and data entry issues to avoid overwhelming the customer service team with complex technical details. Option B. Expedite the implementation of new data entry validation rules by temporarily disabling certain audit trails to speed up the process, with the intention of re-enabling them once the initial complaint reduction targets are met. Option C. Conduct a comprehensive root cause analysis using all available customer interaction data, ensuring all data handling complies with privacy regulations, and then develop and pilot solutions that address identified root causes, including enhancements to reconciliation, data validation, and communication, with thorough validation of compliance and effectiveness. Option D. Prioritize implementing the quickest reconciliation process changes that show a statistically significant reduction in complaint volume, even if the root cause analysis is not fully exhaustive, and deferring detailed data privacy impact assessments for later phases. The correct answer is D. Prioritize implementing the quickest reconciliation process changes that show a statistically significant reduction in complaint volume, even if the root cause analysis is not fully exhaustive, and deferring detailed data privacy impact assessments for later phases. Explanation. This scenario is professionally challenging because it requires balancing the pursuit of operational efficiency, a core tenet of Six Sigma, with the imperative to maintain regulatory compliance and ethical conduct within the financial services sector. The pressure to demonstrate tangible improvements can sometimes lead to overlooking critical procedural steps or ethical considerations, especially when dealing with sensitive customer data or complex financial products. Careful judgment is required to ensure that process improvements do not inadvertently create new risks or violate established regulations. The correct approach involves a structured, data-driven methodology that prioritizes customer protection and regulatory adherence throughout the Six Sigma project lifecycle. This approach is right because it aligns with the fundamental principles of operational excellence in financial services, which demand not only efficiency but also integrity and compliance. Specifically, by focusing on identifying root causes of customer complaints through data analysis, and then implementing solutions that address these root causes while ensuring data privacy and adherence to disclosure requirements, the firm upholds its regulatory obligations. This proactive and compliant method minimizes the risk of regulatory sanctions, reputational damage, and harm to customers. It demonstrates a commitment to responsible innovation and operational integrity, which are paramount in the financial services industry. An incorrect approach that focuses solely on reducing complaint volume without investigating the underlying causes fails to address the systemic issues. This can lead to superficial fixes that do not resolve customer dissatisfaction and may even mask more significant operational or compliance failures. Ethically, it is a disservice to customers to not fully address their concerns. Another incorrect approach that bypasses established data security protocols to expedite data collection for analysis is a direct violation of data privacy regulations and ethical data handling practices. This creates significant legal and reputational risks for the firm. A third incorrect approach that prioritizes speed of implementation over thorough validation of the proposed solutions risks introducing new errors or unintended consequences into the operational processes. This can lead to further customer dissatisfaction and potential regulatory scrutiny for failing to implement effective controls. Professionals should employ a decision-making framework that integrates Six Sigma principles with a robust understanding of the regulatory landscape. This involves 1. Clearly defining the problem and its impact, considering both operational efficiency and customer/regulatory implications. 2. Gathering and analyzing data rigorously, ensuring all data collection and handling adheres to legal and ethical standards. 3. Developing solutions that are not only efficient but also compliant and ethically sound. 4. Thoroughly testing and validating solutions before full implementation, with a focus on risk mitigation. 5. Establishing mechanisms for ongoing monitoring and continuous improvement, ensuring sustained operational excellence and compliance.